In this video, we will look at the recent Goldman Sachs home price prediction for 2022, and we will also see what other experts are saying, and we'll discuss why there's a difference. Hey guys, my name is Mac Rogers. I'm a real estate broker here in the Bay Area, specifically in the East Bay. Welcome to the channel. Let's start off with this. Goldman Sachs recently said that they believe that the housing market could go up by another 16% next year. Now, if you follow the channel, you've probably seen this graph that I shared before. It's the housing forecast for the rest of 2021 up to 2025. This is from Pulsenomics Home Price Expectation Survey. I've gone off this chart for several months now, and what is striking is that Goldman Sachs is not on the same page for 2022 as of this survey. Their forecast calls for 16% increase in home prices. That is almost triple what the current average is. I want to share with you what other experts are saying before we go into why Goldman Sachs thinks that this will be much higher, and then I'll share with you my thoughts as well as to why there's this dichotomy between them. Let's start off with this. Here's a quote from Bill McBride from Calculated Risk. He says this: "My sense is the Case-Shiller national annual growth rate of 19.7% is probably close to a peak, and year-over-year price increases will slow later this year." Most experts do believe this, and most consumers also believe this, and that is that we should be in some, near the top of the prices. Most people, all they can talk about lately has been the market's been up for forever, there's a bubble, house prices have gone up, and the economy's bad. So that's the thinking out there right now. So what does that mean? As you are out there seeing things like prices have peaked, price increases will slow later this year, this sparks questions and uncertainty. And then you see Goldman Sachs saying, hold on, wait a minute, we think that it's going to go higher. It creates confusion in our minds, and what I'm going to bring to you today is some context and clarity of what's happening with prices and why it's so hard to forecast going forward. So let's start with a look at the July 2021 year-over-year home price appreciation. This is the latest data we have, and FHFA is showing that home prices have appreciated by 19.2%. CoreLogic is showing year-over-year appreciation at 18%. And the S&P Case-Shiller Index is showing 19.7%. So this is dramatic. This is incredible home price appreciation. We all know this. And as we look at this, it is largely due, as we have been saying for months now, supply and demand. We simply have not had enough homes on the market to meet demand from buyers, and that causes prices to increase. So let's take a look at what this looks like across the country. This is our price appreciation map year over year for Q2 of 2021. Now, what you can see here is that the states in red have over 20% appreciation over the past year. As a whole, 17.4% for the United States. But you can really see how it breaks down by state right here. Now, what we're starting to see is that the forecast for going forward and what experts are projecting going forward. And that's where this dichotomy between what other experts are saying and what Goldman is saying. And mind you, I'm only talking about 2022 in regards to the difference. I haven't seen what Goldman projections are for the other year. So let me show you what that means. Again, this is the estimated home price performance, and it's from the Home Price Expectation Survey. What we can see right here is that through the rest of 2021, home prices are expected to continue to increase at 11.74%. So that means continued appreciation. And what we also see is that that's not as massive as what we've seen over the past year with 18%, 19%, almost 20% appreciation. So a more moderate pace through the rest of this year. And going forward, as we look at 2022, 2023 and beyond, we're seeing continued appreciation, but that more moderate pace of 5.82% for 2022 and so forth. So what that means is that home prices are not expected to decline. They're just expected to appreciate at a slower pace. Goldman says that for 2022, it will be more like 16%, which is huge. And this is why they're saying this. They, meaning Goldman, They believe that the shortage will linger on longer and also uncertain if the market will normalize by then. Now that is in stark contrast to the other housing experts because most believe that with the last few years of rapid price appreciation, the projected increase in inventory as well as projected increase in interest rates, the assumption is that this should slow down price appreciation to a much more normal level. Goldman Sachs is actually interpreting it this other way. They believe that even with increase in inventory, demand will still be high, particularly from millennials, even though this group of buyers think it's not a good time to buy. They also cited that construction still won't meet demand. There are two factors preventing home builders from building more homes. One is the labor shortage, and two is the supply chain disruption. So even with that, what is currently being built is not enough. Then we still have this low interest rate environment. While interest rates are projected to start increasing, but more and more experts are thinking that will be a longer process as we climb to levels that buyers might start to think that it's too expensive. Personally, I think anything under 4.5%, buyers are still going to be okay. I think Goldman's projection of 16% could be closer to reality than other estimates. Yes, it's true, home prices are expensive, but they are not unaffordable, and really the demand from millennials wanting to start their lives is what will push prices higher. In that sense, I think Goldman's projection could be true. I think the important point here is that prices are not going down. So home prices are definitely still increasing, again, due to supply and demand, and not expected to decline. And so what's really important is that we understand that buying now before home prices continue to accelerate is really important. So getting in while mortgage rates are still low. We know that mortgage rates are ticking up. We know that home prices are expected to continue to rise. It will only get more expensive if you wait. And you know, we always say, if we could go back 10 years and do it again, would we buy another home? Because the value has increased exponentially. And most people will say, yeah, I'd buy a home again. And I'd probably buy 2 or 3. So that's the message I really want to share here, is that home prices are not expected to depreciate. They are just going to be appreciating at a slower pace. Even Goldman's projection is actually less than the previous year's appreciation. The other question that a lot of people are asking about, what about this fourth quarter? How is this year going to end? And normally about this time, things are starting to slow down and we start forecasting for the next year. And as we can see, it's sort of hard for forecasters to go out and make any type of assumption on what's going to happen because of the last year and a half of the pandemic and how unusual it's been. So for the next couple of minutes, I'm going to try to explain the position the forecasters are in and show you really what we need to be looking at. And then we're going to wrap up the talk about interest rate, probably one of the biggest issues right now that people are looking at. So let's start off from here. Diana Olick from CNBC, she says this: fall is usually the start of the slower season for the housing market, but nothing is usual in today's pandemic-driven housing market. Potential home buyers are seeing a slight rise in inventory and consequently rushing back into the fray. Now, a couple of weeks ago, I can tell you from experience that my clients weren't in any rush. And then this past week, we've seen again an increase in buyer activity. Mortgage applications to purchase a home jumped 7% last week from the previous week. And that is the highest level since April of this year. So people are saying, hey, we want to get back in. We're seeing rising inventory levels. And forecasters are struggling with how do we forecast the remainder of this year? You see what's happening? Slow down, then increase again, then slow down, then increase. And the bottom line is home sales are very difficult to forecast right now because of these three lines. Take a look at this graph. This is the annualized home sales from 2019, 2020, and the green line 2021. And what you see there is that 2020 was nothing like a normal year, which we saw in 2019. So if we want to go back to a normal year, we have to go back to 2019 and look and say, okay, what did that look like? because we know what the pandemic brought. It brought this orange line here on the screen. You see the dip down, the rise back up. And we sort of did a double duty in the second half of the year when we packed all that buying and selling activity in such a short amount of time after the lockdown. Many people, because of low interest rates, because of the needs of homes, of a home changing, because of all the things that we've talked about on this channel, rushed back into the market, and it became this abnormal year. We've had more transactions in sale of homes last year than we've had before. And we know the story of that. So let me break down why it seems like things are slowing down. And this is probably the best visual I could give you of why that seems that way. The front half of the year, we talked about all the things that we were going to see, from inventory to annualized home sales to so many things that were going to be up over year because we were in a lockdown. A lot of people took their homes off the market. The business slowed. The economy slowed back in the spring of 2020. And then this year, the spring of 2021, we were over that, but simply because things were in a lockdown. Well, we're about to enter a time in the latter half of the reporting season, the end of summer into fall and into winter, where we pack a ton of business, and we're going to be below that orange line that you see. And folks are going to say, hey, we're down year over year. And you're already seeing that happen. You're down in home sales, or we're down in home sales, and foreclosure is rising. Now, we've talked about that issue extensively here, but realize that's kind of the situation we're heading into. But the reality is we're beating 2019, which was a very, very good year in real estate, and the last normal year that we can look at. And you see right where we've been when I isolated 2019 and 2021 here on the screen. You can see right where we're at. And so the reality is we saw 2019 being one of the best years in the last 10 years in real estate, and we're still ahead of that right now. This is a look at existing home sales going all the way back to 2012. And you can see right here, 2019, the best year except for 2017. 1 year was a little bit better in existing home sales, but we're doing very, very good. So if I take things back where we were just a moment ago, home sales were very, very difficult to forecast because forecasters don't know what's going to happen. Now, in a minute, I'm going to talk about what I believe we really need to be, concentrating on. But the truth right now is they're looking at this and going, okay, there are a couple of different options here. We're going to come through here and level out or be in the middle where we were in 2020 and above where we were in 2019. What you're going to see happen is you're going to see half of the headlines say, hey, we're ahead of where we were in 2019. And the other half, it's going to say, we're down year over year. And there's going to be confusion. And obviously, some people are going to get scared. And this is really the situation that we're in right now, where we packed so many transactions in the last year. We're going to be below that, no doubt. But we're going to be ahead of the very normal, great year of 2019. And that's the kind of the quandary that these forecasters are in right now. They don't know what to expect because things have been so unusual for the last couple of years. Now, the one thing that I do think we need to look at, if you want to know what the future of the real estate market is going to be, we want to look at active listings. And this is a look at active monthly listing counts 2017, 2018, and 2019. Remember, I said 2019 was the last normal year. So we're going back 3 years. And what typically happens in our business is listings peak sometime in the fall and then drop off. And we repeat that cycle. You can see here for the last 3 years before we got into the pandemic, 2017, 2018, 2019, listings peaking in the fall and then dropping off and starting over a new year. And then we know what happened to 2019 and 2020. Well, in 2020, monthly listing counts peaked in April. They peaked, then everybody rushed back into the fray and we started to dwindle listings all across the country. Now, this sets up the challenge moving forward, has always been closing that gap. As those listings drop, sales shot up. So listings are going down, sales are shooting up, and the big question becomes now, when will listings peak this year? And so if we saw listings drop last year, we bottom out here in the front part of the year, less listings on the market than we've ever seen. The question is now, when will they peak? And there are three scenarios. One is they're going to continue to grow and we're going to eclipse where we were in 2020. And that's going to give us a little bit of relief in the frenzy in this market and pricing relief also. There is a second option, and that just flattens, it just flattens out and continue on there and probably intersect where we were in 2020 at some point. And then there is the third option where listings peak and begin to dwindle. If the third option happens, that's where you see more price appreciation. It's upward pressure on prices. But I think there are three reasons why we will see continued listings going into the fall. First of all, pent-up seller demand. No doubt homeowners are going to be more comfortable putting their homes on the market as more people get vaccinated. They feel comfortable from a health perspective. Number two, new construction is starting to take off. Now, even though it won't be enough, it would still help. Builders are realizing the opportunity, trying to build as much as they can. Now, this past year, they've had a lot of headwinds, as I have mentioned earlier. Material costs, specifically lumber, all the things that they need to build a home outside of lumber, all the labor costs, the labor shortages, these are headwinds that builders have been facing. But they're starting to turn the corner and build and see the opportunity, what the opportunity is for them in this market. And number three, the end of forbearance will create new listings. Now, we've gone over this extensively on this channel. It's not going to create this wave of foreclosures, but it will create a time in the market for people to say, you know what, we can't afford our home any longer. We're going to have to put the house on the market. So I think there are a lot of reasons right now that we'll see that listing number begin or continue to climb. But at the end of the day, we're going to have to watch it. If we really want to know what's going to happen, and this is the question, what's the market going to do? We have to watch listings. Now, the other big story right now is interest rates. No doubt we're starting to see some movement in interest rate for a lot of different reasons. But I want to talk about that for just a minute. And I'm certainly not here to say that the sky is falling or interest rates are going to shoot up. But what I want to give you is look at what interest rates are doing so that you can be educated on this topic as well. There are a lot of things that could bring home prices down, but the single biggest risk to housing is rising mortgage rates. And right now, that is a possibility. It's going to be more expensive for people to borrow. Right now, the 30-year fix just jumped above 3%. It's sort of crazy that we're talking about rising interest rates, a rising interest rate environment, and we had an average 30-year fix of just over 3%. You see right here, 3.01% as recorded by Freddie Mac on their weekly survey. And that jumped as they're starting to see indications of the Fed saying, we're going to taper soon. The Fed came out and said, we've been buying this mortgage-backed securities. We're going to start pulling back on that. So the issue right here is the economy is recovering, not recovering as quickly as they would like to see. But the Fed is saying, hey, we're going to start to taper and what we're buying in the mortgage market, so that's causing interest rates to climb. Now, I think it's important that we realize we're in a great environment right now. It will cost more to buy as homes appreciate going into the next year, as interest rates going up also next year, but nobody's calling for this sharp spike in interest rates. Here are the latest projections in interest rates from Fanime, Freddie, MBA, and the National Association of Realtors. And you can see somewhere around the middle of the third quarter of next year being about 3.5%. So we're right about here right now, right around 3%. You see the drop in rates through the pandemic and starting to inch back up. Freddie Mac saying by the third quarter being around 3.7%. And again, I'm not here to say that this is where interest rates are going to be. I don't think it's going to be 4% and probably, not under 3.25%, maybe somewhere in the middle there. Again, probably around 3.5%, maybe a little bit more, maybe a little bit less. But no doubt, interest rates are going to increase. So what does that look like in terms of payment? In this example here, I've got a $400,000 loan that somebody may obtain to buy a home. And if they look at 2 3/4, which we've seen for quite a while now, that payment is around $1,633. If we go up to 3%, it's around $1,686. Not exactly earth-shaking, right? But if the interest rates go up in the next year, knocking around, let's say close to 4%, that rate now allows you to buy a lot less homes. So I'm sharing this so you can see the correlation in regards to price increasing and rates going up. It's going to cost more in the long run to buy a home and certainly to finance that home. Let me show you how this looks like also if you are buying a house here in the Bay Area. So as I end this video, one of the things that people talk about here in America is wealth creation. And guess what? Owning a home is one of the keys to accumulating wealth. The American dream, right? It not only provides us shelter, but also as an investment vehicle. I've also said this before. Owning a home is a hedge against inflation because you have fixed payments. Rents might go up, but your payment will stay the same. Obviously, there are other financial and non-financial benefits of home ownership, but it helps people build wealth, no doubt, all across this country. So the question right now, with rising interest rates, prices going up, many people are saying, you know what? I don't want to buy right now because I don't want to buy at the top of the market. How is that working for you? What are you seeing that others are not? I've seen it so many times before. They say, I wish I would have bought 3 years ago or 10 years ago. I see it a lot. Look, the home price expectation survey just came out. If you look at the $350,000 home over the next 5 years, the purchaser of that home stands to gain just over $111,000 in gained equity based on forecast appreciation for the next 5 years. That's not even counting on the Goldman Sachs higher projection for 2022. So again, what's the top of the market that you are referring to if you're waiting to buy? If it's expensive now, it will just be more expensive later. I know this was a long video. Thanks for watching. Let me know what you think or where you think prices will be like next year in the comment section. Have a great day.